Okay, we're going to get a very, very strong start. But what after is the question. Anuj has hopped across from the Nexo studios and he's here for a quick trade setup. Anuj, over to you.
Yes, Prashant, today is just like, that Virender Sehwag kind of day when, the bowler is tired and finally, the ground is clear. You just got to go out and hit it out of the park. Big short covering in US, of course, after the inflation data with the belief that maybe the data over there has peaked. Back home, you have the Infosys numbers, so that's going to be good. And all of this coming right from the 200-day moving average. The only issue is that you have a 350-point gap up, and this is where the banks have been making. Indian should be allowed to trade at least the index futures, because otherwise there's just too much disequilibrium. You start 350-point higher. But my sense is today could be a day to chase, because there's a lot of call writing which has happened at 17,000 and 17,200, and I think those call writers will be really trapped. Above 17,325, there's no major resistance till 17,500. 17,325 is also going to mark a higher high on a closing basis. The Nifty protected 16,818, the level I've been talking about for the last 3 or 4 days, as the lower low. So that's got protected. Now 17,325, if you close above that, maybe you move to 17,500. I think the index to focus on would be the Bank Nifty, because while everyone's focus will be on Infosys and IT, that may actually give you a much bigger gap up, and Bank Nifty perhaps may not give that much gap up. So if the Bank Nifty gives you good traction, maybe even a 1,000-point rally today is possible. 39,500, I won't rule that out on Bank Nifty today.
Okay, Anuj, thanks a lot for that. So it's a big global party, right, that we're a part of. Just look at the way Hang Seng is moving right now, 3.5% higher for that one, and expected to be a big bang opening this morning. But one stock that may perhaps not participate in this upmove is Cyient, because it posted a disappointing set of Q2 earnings. Revenues and margins have both come in below estimates, but the deal wins this quarter are quite good. They came in at a 4-year high. The company has also maintained their FY23 guidance, with the revenue growth expected to be at 13 to 14%. And they have a visibility for $1 billion of revenues by FY24. Krishna Bodanapu, the MD and CEO at Cyient, joins us now to talk about that. Mr. Bodanapu, good morning and thanks for joining in. I want to talk a little bit about your guidance for FY23 and FY24. Given the kind of macro challenges that we're sitting on, perhaps the US heading into a recession as well, do you think it may be tough to meet this $1 billion revenue run rate by FY24?
Good morning, and thank you for having me on the call. So we looked at all the industries that we're in and looked at what is the impact of any potential recession on these industries. And then we took the call that it was quite possible that, or it was quite within range for us to hit that number. Because if you look at some of the things that we're doing, be it the energy transition or be it the semiconductor transition between the plants moving from China back to the US or Europe, we participate in a lot of that, and I think those things will continue. I mean, of course, if it's a black swan event, then we can never estimate what happens. But we're quite confident that as things stand and as things are continuing, we're in a good position because of the way or because of the work that we do and the kind of industries that we participate in.
Okay, all right.
So that's we're confident.
All right, Mr. Krishna. So good to hear that you're pretty confident, but the street still believes that it's going to be a tall ask for you to maintain the guidance that you've given for this year itself. That's FY23. You're sure you're going to do that, right? I think organic growth guidances were around 13 to around 14% and margins as well in that vicinity. Do you stick to that? And just doing a rough math, you're currently doing around $175 million per quarter. For you to get to that $1 billion odd, you'll have to do around $250 million. When do you get to that particular number? Sometime in FY24? Which quarter do we look at you scaling the revenues to that level?
We're looking at the second half of FY24 because one other thing I'll mention is out of the 170 odd million that we did this quarter, the CTech, which was a big acquisition that we made in Finland, that number is not fully baked in. I mean, that itself will give us 2 months of uptick in the next quarter. So the run rate itself becomes quite a bit higher because of that. So we are, it's close to a $200 million number in that case. So we're really going from a 200 to a 250 number. That's essentially the math over there. So therefore, it is well within the possibility of how things will pan out over the next couple of quarters.
Mr. Bodanapu, deal wins in the services segment have fell almost 9% on a quarter-on-quarter basis. Could you give us some sense of what happened there?
Two things, right? One is it's just seasonality in the quarters. If you look at it year on year, there was still a growth, and especially we have to, unfortunately, now we have to also look at constant currency versus the dollar, given the fall in the dollar. So if you look at the year on year, there's actually been quite a good growth in constant currency in the deals. And also, if you just look at what's been flashing, that's the 5 large deals. Those are just the large deals. There's also a number of other deals. So that's not the total deals that we have won. Therefore, Q2 is what it is. I mean, again, if we look at a year-on-year number, we're actually tracking reasonably well in terms of what happens. And therefore, we're quite confident in terms of where the order book stands and where there's enough of potential for us to further grow.
But if you slice through different segments, right, the rail transport segment is looking quite weak for you. There's been an excess of 8% fall over there. Do you anticipate further weakness? And what is the contribution to the overall order book?
The rail segment is roughly constitutes about 7% of our overall revenue. It's been a tough segment. I think both for us and the rail market in general have been going through quite a bit of a lull. We believe that we've bottomed out. Again, it'll be a bit like what happened with the aerospace in 2021, where there was a bottom and then we stabilized at the bottom. And of course, now we're seeing some good growth in the aerospace segment. So what we believe is rail has bottomed out. It'll remain here for a couple of quarters, and then Q4, Q1 onwards, we're seeing some good growth. But it's about 7-8%. So that's the one segment that's still quite disappointing for us, and that's the one segment that still has a bit of risk. But again, it's a relatively small segment now. Whereas the larger segment, especially, aerospace, which is obviously a segment that we're well known for, and it is something that that people associate us with, has now shown a double-digit growth in constant currency. So I think the larger segments, communication, aerospace, are doing well, and therefore we can still mitigate against them.
All right. Mr. Krishna, the attrition, you were hoping that it's going to cool off. Though in the past quarter, it's still around that 28.5% odd. Do you believe it has finally peaked out now, attrition, and it will cool off from there? That's point number one. And the second factor is, you mentioned about SciTech. I recall we had a chat earlier in the year when you acquired that asset, and I think it was doing around 80 million euros. That's what it did for 2021. What is it likely to finish 2022 with? A very, very rough number from that 80 million euros on?
So in terms of dollars, it'll be about $80 million just because of how euro and dollar have panned out. So roughly that'll be the number. I think it'll be a little bit higher than that, actually. Sorry. It'll be, I think, $84 or $85 million is roughly where the number will be. And in terms of attrition, it has cooled off. I mean, it's come off. I think 26.5% was the attrition that we reported for this quarter. It has come off about 3% compared to the previous quarter. So we are seeing that downward trend on attrition. But having said that, I think definitely we need it to come down to more in the tens, maybe 18 is what we would be quite comfortable with. So we still have a lot of work to do, but I'm quite pleased that it has come down from Q1 to Q2.
By
and that
when?
trend.
By when can we see that targeted 18% that you're talking about?
I think 18% is a bit of dependent on the market as much as on us. Therefore, we believe that it'll happen possibly towards the end of this year. That's where because we see some good potential already in terms of future resignations, etc.
I have two questions. You briefly alluded to the aerospace vertical. Is that sort of going to take off in a big way? I mean, air travel is back, certainly. I mean, I'm talking about domestic, global, and just some longer-term guidance there, because that's an important vertical. And second, for the design-led manufacturing vertical, the DLM vertical, which is about 15% of revenues, you were selling that off, right? Could you provide us with an update where that is?
Okay, so aerospace, yeah, we think that the turn up is starting to happen. I mean, we've had some obviously some challenging quarters there, but things have stabilized quite a bit, and we're actually seeing growth coming back on the MRO piece of the segment. To your point, air travel is coming back, air travel is picking up, and therefore that whole MRO segment is actually picking up for us. The new design starts still have not happened as we anticipated, that they would take some more time to happen. And when that happens, we'll see some further acceleration in that business. And again, I think we're well positioned there. We've seen the worst of it, and now actually we're quite well positioned with the aerospace segment. On the design and manufacturing, the board has appointed a subcommittee. I just want to say we've not taken a decision on fully selling it off. We believe that Science should still have some involvement because we're winning some very good deals based on the fact that we can do engineering and design. So we're actually winning some very good deals. So we don't want to break our involvement with the business. So we're looking at potentially an IPO or bringing in a bringing in a strategic partner to participate in that business. So the subcommittee has been appointed. I think it was 2 weeks ago when we made that announcement. But we will start to see some action on it. I think we meet twice a week now, and we're evaluating all the options. As soon as there's a definitive option, we'll let our shareholders know. But right now, the idea is we still want some involvement, but the shareholding of that business doesn't lead or doesn't lend very well to where the growth potential of that business is.
This is right now fully. This is part of the listed entity, right? Fully owned.
Yes, it's 100%.
And it, as you said, this is going seeing good traction. At least this quarter, it won a large order from Honeywell.
Correct.
So, and you're saying that you could spin it off and list it separately. That is also an option after you get an investor in it.
Absolutely.
By when do you decide? By when do you decide, Mr. Krishna?
This quarter we will decide.
By quarter 3, you'll know your audience will know whether or not the investor comes in or it's an IPO, right?
Yeah, within quarter 3, you will know. Yes.
Okay.
And what could be the valuation of this business? I mean, how should one think about that?
I think it's speculative, so I would.
I mean, globally, what do these businesses trade at? I mean, if you can give us some idea.
I think you're a better judge of that because I think
All right.
Sure.
But that's interesting. You're saying you want some part of it. The structure has to be decided. So it's not. It perhaps is not a complete spin-off. Got it.
Okay.
No, it definitely is not a complete spin-off. I want to reiterate that because it's a very good part, and like you also pointed out, the Honeywell deal is a great deal for us to use as a case study. So no, we will not do that. We will still hold some ownership.
Okay, still hold some ownership there. You spoke about your $1 billion target by FY24. What will the amount of money that comes through from acquisitions, what will that be? I think earlier you had alluded to $150 million on an annualized basis. Is that the run rate that you're looking at?
Yes, absolutely. That's the run rate. We don't anticipate any further large acquisitions on top of that. But it's this $150 million that's already baked into that.
Okay, so no further acquisitions planned by the company?
Nothing significant.
Okay, all right.
We do need.
Sure. Okay, thanks a lot. We've got that. We'll leave it at that. That's Cyient, down almost about 3%, but they are quite confident that they will meet their $1 billion target by FY24. But for the market, it's looking pretty banging this morning. The Nifty is up over 300 points, crackling in terms of the moves on Infosys, up almost about 5%. You have ICICI Bank that's up 3.5%. Ashok Leyland from the broader markets looking good. Good numbers from Mindtree, Angel One, Navratri. So those are a couple of stocks that you should be looking at this morning. But Mitesh is with us. Mitesh, what's the big call at 9:10?
Yeah, I think there'll be a big gap up opening, but again, sticking to IT still might help. So we had a buy on Coforge. I think that's opening about 1.25% up around 36.75-80 zones. That can be bought with a stop below 36.45 for targets of 37.50.
All right. Sticking with IT, and Mitesh, want a view on this one as well. Mindtree, right, reported a stellar set of numbers. Rima is here for a quick update once again. In pre-open, it's indicating a 4% higher start. Rima, over to you.
Thanks so much for that. Well, Ambit called it a perfect quarter, but the outlook is a bit hazy. So Q2 numbers by Mindtree have delivered a beat on all parameters, and that's the reason why brokerages too have gone ahead and raised the target price. So Morgan Stanley raises the target price to 3,400, Nomura to 3,180. But in terms of the rating, you would see it's largely neutral, and that's on account of the high valuations Mindtree trades at. It trades at the valuations of large cap peers and even more than that. Actual numbers, dollar revenue growth of 5.7%. Constant currency revenue growth is more than 7%. That's a fantastic number, much higher than street expectations. The company's EBIT margins were flat. The street was anticipating a decline in margins due to wage hikes, but the company was able to absorb the impact of wage hikes and report margins of 19.2%. That said, although this was a perfect quarter, it's a beat on all counts, even the deal wins, etc., everything looked good. The only issue is the management commentary was a bit circumspect about the outlook. So one, retail is a large portion of their client. They've been seeing ramp downs in a couple of their retail clients. That, the management said, has ended. But in Q3, there will be some furloughs in the retail client. But they also called out a couple of the other sectors like manufacturing, logistics, or Europe. So the management was a little more cautious. So we need to watch for the growth in H2 of this year as well as FY22. So all in all, it's a good quarter that's come through from, Mindtree, and the stock, of course, is reacting to that.
Okay, all right, Rima, thanks a lot for that. Well, I'm just going to run you through a note coming in from Kotak on aluminium stocks. They've downgraded Nalco to reduce and Vedanta to sell as well, and the target prices as well come up for you. Though they maintain their buy on Hindalco because it has a Novelis factor. So that's why they're expecting earnings to remain resilient for Novelis. Well, Indian aluminium producers, they say there's a two-part headwind for them. One is that higher coal costs. The second factor is LME prices have been lower. So on the back of that, they've cut their EBITDA estimates for Hindalco, the least actually, 4 to 5%, for Vedanta by 12 to around 9%, and on Nalco, they've cut it by around 29 to around 17% for the next couple of years. The cut in LME prices is on the assumption that they've lowered the LME assumption itself by around 7 to around 8% odd. And they're saying, yes, there has been capacity shut down globally, but they believe demand is far weaker, and that explains the cut. They also highlighted the fact, and something that even Rakesh Arora said last week, that physical premium on ground, well, that's contracted. That's giving a sense that actually demand is weak globally. So put all these factors together, Kotak not too impressed on aluminium stocks.
Okay, well, another stock to look at is HDFC Life. We told you about it earlier. They've got the final nod for the Exide Life merger. So that stock, HDFC Life, is also in the green, but so is the market. Just about a minute to go for the market to open. Brace yourselves for a very positive opening today. The Nifty is indicating a start 300 points higher. The stock to watch, of course, will be Infosys from the large caps and Mindtree from the mid caps. But I'll also watch out for names like Tata Elxsi that come out with their earnings later today. Perhaps after good numbers from Infi and Mindtree, there could be some buying action over there. So here's the first tick coming through on the opening bell. Straight off the back, it's a 280 point, 290 point uptick on the Nifty. Now 300, so a triple century there. Sensex up over 1,050 points. Just look at that. And big gap up opening even in the mid-cap index. The stock that is taking it away is Infosys. So top honors there, 4% higher post its numbers. The buyback and a lot of brokerages raising their target price on Infosys. ICICI Bank is the other one. It's next in line, up 3%. And IndusInd Bank is the third Nifty gainer, up almost 2.5%. In fact, the Bank Nifty is now charging ahead, 900 points higher on the Bank Nifty, led squarely by ICICI Bank, but it also has SBI, Axis Bank for Company, HDFC, Kotak Mahindra Bank are all up about 1 to 2%. So it's a secular run on the upside, led by the big pullback rally globally. You have auto stocks like Tata Motors, Eicher Motors that are also doing well, M&M, Hero MotoCorp, all your consumption favorites. The only stock in the red today is ONGC, at least in early morning trade. And some of these pharma stocks have taken a bit of a backseat. So Cipla, Sun Pharma, Apollo Hospitals in the green, but not as much as some of these high-risk stocks. So for now, 300 points higher on the Nifty and cracking opening.
Well, what a cracking opening, Sonia. And, the Nifty and the Nifty Bank, both of them are trading above this crucial level. So the Nifty is above the 20 DMA. The Nifty Bank is above the 50 DMA. The bulls will like the start at least, and they would like the index to hold above these levels. So just keep an eye out on that front itself. Few more stocks that are in focus. BHEL, well, that stock is up close to around 3% odd, so that's moving higher as we speak. And let's see what the earnings reactions are. You have Angel One that came out with a set of numbers, as well as Navratri. Both of them should come up for you on the screen. Angel One, well, that one's opened up with a gain of close to around 3% and Navratri is up close to around 6.5%. So a thumbs up for both those two numbers. NMDC, we already had news that the MCA has approved this demerger. Now, in fact, the record date has come in, and that's why that stock is up close to around 2.5% odd. If you want to buy it, you need to buy it before the record date to get those two separate entities. One is the steel business, and one is their core business, which is their iron ore business. So it's a good start to trade today. You have a lot of stocks that are flying off the bat, and things looking pretty good. Just a quick word, the start is good, but even the Indian rupee, let's see if we're getting a reaction out there, because the dollar index has cooled considerably from around that 114 plus that we saw post the CPI number. It pulled back to around 112.5 odd. The rupee, if it can move to around that 82 odd mark, well, that'll be the icing on the cake for the bulls. I think we should keep an eye out on that one as well. Pulling back towards 82. So a perfect start there.
We've got to get our Bhangra lessons in place, right? Perhaps it looks like it's going to come sooner rather than later. The 18,200.
Next week then. I mean, 300 points. I mean, this is as strong as they come, and it's looking good. I mean, the Nifty IT is there's been so much up and down and so much debate, and whether this is getting very fast into a buyable kind of zone. But now Friday to Friday, and we're just starting the day, so things could change. But we are up. We are up another 1.33% this week so far, after last week's 3.5% move. So these are extremely profitable, high-quality companies, and they remain the most bombed-out space relative to other sectors which have picked up. There's not really been too much pickup, but they also are, occasionally hurt by this constant stream of a slowdown and a recession and all that talk coming from the US. So it's been a story of a little ahead and a little back as well. But let's put some of these points to Saurabh Mukherjee, who's our market master today. He's founder at Marcellus Investment Managers. Saurabh, great to have you with us here. Thank you very much for your time. So let me ask you straight away with regards to IT services. I mean, the index is up strongly today. How do you assess prospects for this group of stocks from a medium to long-term perspective from here, from these levels?
Well, look, Prashant, I've been saying for several months, I don't understand why anybody was circumspect or bearish on IT. It doesn't make any rational sense to me. It's like trying to time the steam engine demand cycle in the middle of the industrial revolution. For obvious reasons, these companies are doing well, not just our holding TCS, but other companies like Infosys are doing very well. I think even HCL Tech had healthy results. And I think that will continue. The West is only 1/3 of the way through the shift to cloud. There's tons of work to be done. So it doesn't matter what the GDP growth in America or Sweden or UK is. The Indian IT services companies will carry on getting plenty of work. And on the back of that, they'll post healthy results for many years to come. So I really was bemused when through spring and summer, some people started turning bearish on IT. It made more logical sense to me.
Okay, but what does one do now? Saurabh, hi, good morning. Because, we still have a long way to go before all the IT numbers come through and you get a proper sense of which way things are headed. There's also the US recession, inflation, etc. So there are risks on the horizon. Do you buy now, or is it still wait and watch mode for IT?
So first point, I think for everybody to get clear in their heads, the US recession has historically been a positive thing for India. Right. So if you look back at the last 40 years, we've never had a stock market boom in our country without a recession in America. As you're rightly saying, officially, the US is already in recession. The reason the US recession historically has been good for India is twofold. One, it conks off oil prices, and two, it brings down the cost of money. The cost of money argument this time round perhaps isn't as powerful because of the inflationary backdrop and the rate hikes in the West, but the oil price relief is already palpable. In the last 4 or 5 months, we've seen crude come off 30%, and courtesy Russia, India has got even cheaper crude than that. So the US recession is not something to go home and beat yourself about and sell Indian stocks. It's actually a bullish argument. And leaving that aside, the local vibrancy of the economy, right? The not just the festive season demand, but the overall tax collection buoyancy, the overall macro buoyancy, to my mind, is plain to see. And therefore, the focus should remain on buying high-quality Indian companies rather than doing some, macro forecasting after reading the morning newspaper.
Hi, Saurabh. Morning. On your point on IT, you've held your stance and, you continue to hold on to that. I think TCS and LTTS, right? Those are the two stocks that you'll have in your portfolio from the IT names. Any change out there?
So both continue. We're looking to add other names in the sector.
Okay.
The challenge historically with smaller names in Indian IT, right? Small and mid-cap names, the challenge is they tend to be vertical specialists. They tend to do one thing well.
Right.
And if they do one thing well, it's actually quite easy for the giants like TCS and Infosys to come and blow them out of the water. And hence, we tend to be quite careful about small and mid-cap IT. LTTS actually isn't an IT services company. It's an engineering R&D provider. It just sort of sounds superficially similar to IT. It's actually a very different type of company to, say, a TCS. But small and mid-cap IT, historically, we've stayed away, and I don't think we'll change our point of view. You're better off focusing on the giants. We have TCS, but as you guys seeing Infosys is doing very well as well.
Okay, all right. We categorize it basically as mid-cap IT. So, that's the reason why I asked you under that header. But on the banking space, that's the other pillar for the market. HDFC, Kotak, as well as ICICI Bank, you've been pretty much positive on those three banking names. If we're going to be getting this big credit growth cycle and we're at the start of it, the NPAs as well fall and asset quality is going to look much better, will you go down to tier 2? Will you give the PSU banking names a look, or will you stick to these three names?
No, I think the data in Indian banking actually has been very clear for the last 20 years. It's not a recent thing. The relentless market share gains by the three private sector banks you mentioned, plus the reinvigorated Axis Bank, the relentless market share gains on both sides of the balance sheet is very clear. Whilst it's really encouraging to see what SBI has done in the last 4 or 5 years, I think Arundhati Bhattacharya's reign and the subsequent SBI recovery has been to see. It's still a company with ROEs which tend to be relatively weak by Marcellus standards, and our focus therefore is on the frontline banking names and the frontline NBFC names. The Bajaj Finance or Chola, both are parts of several Marcellus portfolios. A disclaimer here, I hold these stocks, my parents own these stocks, and our 11,000 clients own these stocks. So obviously we have a vested interest in discussing what we own.
Okay, fair enough. That's on the financial space. The other big piece that is recovering in a huge way is consumption, right? Domestic consumption. Whichever way you cut it, whether it's hospitality, autos, aviation to a certain extent, which is the piece that you would like to focus on now? Because there are, of course, headwinds there as well. I mean, in autos, it's sort of chalk and cheese within the space itself. What are you focusing on?
Sure. So look, I think what's becoming really clear in India over the last 4 or 5 years, I think this was the outlines were there before COVID, but after COVID, it's becoming much clearer that consumption which focuses on the sorts of people who are watching, say, this CNBC broadcast, affluent Indians, upper middle class, salaried SME owners, that consumption piece, as you're rightly alluding to, Sonia, that piece is booming, right? So if you look at cars, they've been doing well. In fact, other than the sort of few dire months of COVID, car demand, auto demand picked up reasonably nicely, but two-wheelers continue to struggle. And then generally, the less affluent strata of Indian society is still under the pump. Whilst people like us are doing well, job markets for formal employment are booming. The informal labor market is still in the doldrums. So our focus in our portfolios is, say, retailers like, say, V-Mart, which sells small ticket clothing items in the district towns of northern India. We also have a Titan in our flagship portfolio consistent compounders. And our realization has been that if you focus on affluent consumption, right, so an Asian Paints, a Pidilite in the building material side, a Titan and a V-Mart on the retailing side, you carry on benefiting from the growing affluence of the sorts of people who are watching this broadcast.
All right, that's interesting. Saurabh, have you bought anything new within the consumption space? I mean, there's so many, right? I mean, I don't know if you own any QSR names. That's a play on consumption. Anything new across the spectrum of consumption?
QSR, we can't find QSR players with strong barriers to entry. There's always QSR itself is booming, but we couldn't find players with barrier to entry. We bought Bajaj Diagnostics, which is a Hyderabad-based regional specialist in radiology and pathology. So we bought that in our small cap portfolio, Little Champs. Bajaj IPO'd not very long ago. I think it's 6 or 7 months or 8 months since it IPO'd. We spent 3-4 months traveling around Telangana and Andhra Pradesh, visiting their labs, speaking to ex-employees, speaking to customers of theirs. And we believe that in the Telangana-Andhra belt, Vijay has built a very strongly moated, formidable franchise, very profitable, strong barriers to entry. And that's why in our Little Champs portfolio, we purchased Vijay Diagnostics in relatively large quantities.
Okay, all right. And I think, Vijaya replaced Gujarat Ambuja Exports, I think. So that was the switch that you had done in that portfolio, if I remember correct. What about the pharma space, Saurabh? There's so much of fear that discretionary spend gets pulled back. Well, this could be an area that's actually, it's quoted. I mean, it's protected from that sort of a fear. The rupee as well fairly weak. And I think the index on the whole hasn't done much in the last few years. Are you looking at pharma? And if yes, any specific areas?
So what's I think happened is the Indian pharma companies who sell abroad, right? The Indian companies who sell formulations abroad, they actually have no competitive advantages whatsoever. So I think that story is very difficult to invest in. Indian companies making formulations in India, selling them basically at hugely discounted prices in the Western world or in Latin America. That's we think is an uninvestable story. In pharma, big holding continues to be Divi's Lab, and we continue to be honestly a little amused at the way other people are selling Divi's Labs. So we are very active by purchasers of Divi's Lab. Divi's doesn't sell formulations, it sells APIs, it does custom synthesis and manufacturing for the world's 6-7 largest pharma companies. Formidable franchise, and we think it'll get plenty of work as the Western Hemisphere shifts API manufacturing from China onto India. Divi's will be a massive beneficiary of that switch. Beyond that, the entire supply chain feeding into APIs, which is say raw materials like aliphatic amines, where we have alkyl amines, the glass-lined reactors which are used to make pharmaceutical products where we have GMM formula. They're looking to see if we can buy more things in that supply chain which feeds into APIs. We reckon the API industry in India will do very well over several years to come, 4, 5, 6 years. I think it's a booming demand scenario. China is 6-7 times larger than India in API manufacturing. A lot of that will shift to India. And therefore, the entire supply chain feeding into APIs, we're very excited about that. Formulations, manufacturing of actual medicines, I'm not so sure that's a very clever place to invest in.
Saurabh, great to have you with us here. It's a pleasure. Thank you very much, as always, for being here on the program on CNBC-TV18. 278 points is what we have on the Nifty, 17,290 on the index at this point in time. So there's a slight gentle come-off which has happened from the day's high, but it's not too much. I mean, it's just about okay at where we are right now. I mean, you know, the immediate kind of level on the downside, I think you need to be mindful of that as well, is 17,262. And we highlighted that this morning. We're not quite there yet, but not very far, some 20 points away from that level. That is nothing but the sort of 38% retracement of the fall that we saw from the September high to the September low. Will this dip get bought? I think that always gives a strong indication of what the market will do for the rest of the day. And we just need to wait and watch out for that. Although the dip itself has been just about, 35, 40 odd points or so. Nigel.
All right. Let's get straight to our next corporate. Then TTK Prestige, that's the next corporate we are speaking to. There are widespread expectations for consumer durables that while margin could improve owing to lower raw material costs, particularly in the second half of the year. But to get a sense about how things are shaping up and discuss festive demand and the outlook, we're joined by Mr. T.T. Jagannathan, the chairman of the company. Hi, Mr. Jagannathan. Thanks so much for joining in, sir. Always good hearing your thoughts. So let's get straight to the point. How has the festive season kick-started? And if you want to compare it with the pre-COVID period, that'll be 2019, could you tell us how much better is it? I'm assuming it's better, but how much better?
About 80%.
Oh, all right. So that's that's a big number.
80%.
You're saying from 2019, right?
Yeah. Yes. Yes.
Okay.
Yeah, about 80%.
Okay. So that's a big move.
That's almost a doubler, sir. Right? That's huge.
Yes.
Is it just for you, or is it is it? I mean, how much better are you doing in comparison to the industry?
I don't have that data.
Okay, so this is 80% growth compared to pre-COVID levels in 2019. Can you give us how the sales in Navratri, the early Diwali days, how did that look?
Actually, the sales have been very strong.
Okay.
But last year we had a fantastic year because of pent-up demand. And we had our best ever quarter, second quarter last year. This year we'll match that or grow a little bit on that.
Okay, so then actually, if last year was so good on a high base, how much better is 2022 in comparison to 2021? Or just this festive season?
In the single digits.
Single digit, okay, but it's better. Got it.
But the half year will be very, very good because the first quarter we grew by 71%.
Okay.
Mr. Jagannathan, sorry, just to, we had your CEO with us more than a few weeks back, and he had at that point told us that, sort of entry-level products, which are about 60% of your overall sales there are stagnant. So when you tell us that things are looking very, very strong, this is value sales largely led by premium products, sir? Is that what is translating to this?
No, our entry-level products are not doing badly. But as Saurabh just said, and I heard him, it's the affluent who are buying, and they're buying the better products.
So that's more than making up for any underperformance in the entry-level segment.
Absolutely, absolutely. Because
Okay.
their value is higher, the margins are higher.
Okay, so this premiumization is something that's working for you over the last many months. All right, got that. What about the e-commerce contribution? Are people buying more online in the online channel compared to offline?
Actually, online has dropped compared to last year.
Okay.
People, now that COVID is over, people want to go touch feel, go to the retailer and spend time. And that's happening with the exception of the area between Delhi and Gorakhpur, which is completely flooded.
Okay. And you said that, you know, the affluent are buying more, so perhaps, you know, the premium products are selling more than the entry-level products. Is that making it easier for you to pass on the price hikes, any of the pent-up raw material price hikes that you perhaps had to pass on, and any more on the anvil?
You heard Saurabh again, the raw material prices have actually dropped.
Yes.
So I don't think there's going to be any price hikes in the near future.
And in quarter two, I don't
Okay.
think there was any price increase, right? You said quarter one there was, but in quarter two, you're looking to maintain status quo. Have you done that, or have you?
Correct.
So no price increase. Okay. All right. All right. And Mr. Jagannathan, just to confirm, online sales is around 12% of your total mix, right?
That is correct. It still is.
Okay. All right. You know, the rural market, how is that doing? If you could tell us, and as a percentage of your sales, how much is it?
5%.
Oh, okay.
Mr. Jagannathan, sorry, you said the region, because North is now a substantial, you're not South, only a South company. I mean, I think North is also a substantial portion of your sales. And you said the region between Delhi and, you said it's flooded?
Gorakhpur, yeah, Delhi and Gorakhpur.
Okay. Is that a big market sort of for you?
For Diwali, that's the biggest market for us because Diwali is a big thing in the north.
So
It's not so in the south.
So is that impacting what you may be able to
We're
do during
hoping
this
that
period?
it'll pick up this week after the floods recede.
Okay. So October so far has been, I'm assuming, it's taken a bit of a knock there because it's a big...
It has, that region has.
Okay, that's interesting. You know, the other one is your subsidiary in UK. I remember last time we spoke, you'd said things are a mess there and it's only gotten messier with no real end in sight. What do you plan to do there in UK, sir?
Well, we're revamping the company and we actually had a good September, considering all the disaster that UK is going through. And I think we'll manage to get out of it.
Revamping in what way? I mean, any details?
We are for instance, instead of selling to retailers, we're now going direct to consumer.
Okay.
Okay.
And that's improved margins.
Okay.
Oh, in fact, that was my next question. I mean, you're doing a lot to improve your margins and on its own as well, right? I mean, raw material prices are cooling off, demand is picking up. So there's operating leverage there. Can your margins pick up significantly in the second half? If yes, what would the average be?
Significant is a word I don't understand.
So you're at almost 14% now. You want to give us some specific numbers on how much you could take it to?
It'll probably be 15, 16%. I can't predict it.
Okay. 15,
But
16%.
for a year, I think we'll be 15+%.
That's by the end of FY23.
That's correct.
And are there any more margin levers that you could sort of execute in the next year as well?
We have to wait and see what happens to raw material prices.
Okay. You know, you were telling us that double-digit growth is something you're looking at for this year on the whole.
Yes.
You're maintaining that, right? Around 3,200 crores should be the year end?
That's about it.
Okay. All right. Also, if you could tell us a little bit more, Mr. Jagannathan, about your exports. Currently, I think it's only around 5 to 6% of your total revenue mix. But there's a big opportunity that's coming up, right? Because people are going, you know, the China plus one factor. So that could throw up a big opportunity.
It has. It has. We have got new customers.
Yes.
And we're unable to fulfill them because we don't have the capacity.
Oh, so that's great news then from a business perspective. Say in the next, 3 to 4 years or do you see exports as a percentage of your revenues, or do you see that export number go to say 400-500 crores?
Easily.
Easily. Do you want to give us a number? Say in the next 4 years, what does your export number look like? I'm guessing currently it's 5-6% on 3,200 crores, also it's around 200 crores. So in the next 3-4 years, what does it go to?
500 crores at least.
At least 500 crores.
Okay, that's on the export front, right? That's good news. Any new products that you're going to be launching? I think in the grinding appliances segment, you had new products. You introduced 25 new SKUs last quarter. What's on the anvil?
I can't tell you.
You can give us some. You can give us some indication.
Sonia, you're speaking to a client.
Okay, but at least tell us if there's some potential, I mean, that you're looking at.
Sorry, repeat that.
Is there any potential in newer areas for you? Something that you're working on the drawing board, perhaps?
Oh, lots. Gas stoves, mixer grinders, induction cooktop, pressure cookers. We've recently launched a pressure cooker called Flip-On, which is doing extremely well.
Okay, and you're sitting on free cash of almost about 600 crores. How do you plan to put that to use?
We're waiting for that good acquisition to come around.
Oh, anything that you're looking at closely?
We're trying. We're talking to a lot of people. We're trying.
Anything in this calendar year or this fiscal year itself?
I don't think so.
Okay. All right, Mr. Jagannathan, always a pleasure. It's like sort of a rapid fire, with you, and get to learn so much in such a short span of time. So sort of like an adrenaline rush for us as well. Pleasure speaking to you always, sir. Thanks a lot for joining in, and happy Diwali to you and your team.
To you too. Thank you.
Thanks a lot. Well, that's TTK Prestige, quite energetic and quite optimistic, right? I mean, they're looking to improve their margins, raw material prices have cooled off, and demand overall is looking very good. Let's do one thing. Let's slip into a quick break. We'll get you an exclusive conversation that we had with Kenneth Andrade of Old Bridge Capital Management on the Indian market.